It's definitely a pleasure hosting this type of event for both of you. Wolf, thank you so much for willing to co-host it with me, helping organize everything. So let's go ahead and dive right in. One of the most important things one of the most important things that everyone is talking about last week and this week is, of course, earnings. Start with Brian. I know you and Dylan just did a podcast last week on industry focused podcast and going over some of the highlights for earnings like Facebook and Shopify and Amazon. So maybe you can just give us your take really quick, maybe for like a minute or two. And then after Brian is done, maybe Chris can give us his take on two companies that reported last week, which was Pinterest and Teladoc. I got a lot of questions around Teladoc especially.
Mm-hmm.
Holy cow. What more can you say? It's amazing that companies like Apple, Microsoft, Facebook are reporting revenue growth of 30, 40, and 50%. It is just nutty how big, how successful, how many tailwinds those companies have behind them. The thing that I am curious about for those companies, though, is they are lapping relatively easy comps, and they have the real big tailwinds of COVID kind of over at this point, or at least waning off. So Q1 is going to be, the earnings season right now is going to be nutty. The numbers are going to be eye popping, and even with that, some of these stocks are not reacting as you would assume they would be, given the numbers that they're reporting. That just tells me that the market is looking forward and saying, sure, Q1 is going to be great, sure, Q2 is going to be great, but then the comps get a whole lot harder, and we're going to have to see what happens to those tech companies in that kind of world. So I'm expecting great earnings from Q1 and Q2, but Q3 and Q4 I think will give us a better idea of quote unquote steady state or a return to normal with what's going to happen with those companies. But everything that I've seen, the winners from 2020 are delivering fabulous results, and the laggards are coming back. So it's an interesting earnings season for sure.
Yeah, definitely, to say the least. Chris, would you like to go ahead and cover, just give us a few thoughts on Pinterest and Teladoc from last week?
Yeah, definitely. I second a lot of what Brian said as well. I think there's two things at play here. Number one, a lot of these growth stocks maybe got a little bit ahead of themselves with price. Certainly, the valuations were very high in 2020, and a lot of them went anywhere from 2x to 10x from beginning of COVID to earlier this year in February when we hit that peak. So I think in the case of Teladoc, that's what happened. Here's a stock that was up 10x prior, went into a little bit of a base throughout the 2019 year, and then in 2020 ran from about $50 a share up to a peak that it hit in this past February of over $300 a share. It's recently taken a big hit. It's about 40, almost 50%. It's about 47% off its high now. Growth over the last several quarters. I mean, it was 151% revenue this past quarter, just reported last week. It was 145 before that, 109% the prior, and then 85% 3 quarters back. So you look at the growth in revenue, it's been tremendous, but there's also expenses. They had the merger with Livongo. I did a pretty detailed tweet the other day as far as what I thought on it. The numbers look fantastic. I think there's a big if with Teladoc, and it's my largest hold in my growth portfolio. It's just, can they truly execute that integration? And can they actually roll out the integration of the services that Livongo brings to the table? If they can, I think the stock's going to be fine as we kind of look forward, not just a couple quarters, but a couple years. And I think they can capitalize on that whole person care, and it's 24/7 health monitoring, and that's something that's really big. And it's not just Teladoc, it's Amazon and a lot of their smaller startups that are going to get into the space as well. It's going to be very profitable over the next decade or two. It's just a matter of, can they actually execute it? So I think prices kind of come back to something a little bit more realistic in line with the valuation should be. And if they can execute, and they did say, I listened to the entire call with the CEO and the CFO last week, it's a little questionable as far as what they're going to do this year. And they believe they need the rest of this year to really kind of get that integration and rollout going. So we might not really see Tdoc do much until the end of this year into 2022. For now, I'm holding. I think it was down to 160 and change today, 163, somewhere around that area. I don't have it in front of me, but it's teetering. It's where I bought it. I bought it a little bit higher at this point. Now I've owned Livongo prior, and then I bought Tdoc. So I guess in my mind I can say I've used those funds to buy Tdoc. And I bought Livongo when it was in the 20s before it ran up well over 130. But it's definitely in a position where I'm looking at it, but I'm in for the long run. So I know Brian's very big on when you have conviction, you have your stocks. You're going to have these pullbacks, you're going to have this volatility. But if you truly believe in it, you kind of have to put that to the side and just hold on to it for the long term. So from a short-term perspective, it's a little concerning to me right now, but I still think several quarters out, I think the stock should be fine. So I'm okay there. As far as Pinterest, same thing. I mean, here's a stock that when COVID hit, it dropped down to almost $10 a share, and then it ran up to 80. It's something that I got into a lot lower than I did with Tdoc. So I'm in there in the 20s, and it ran up to 80, and now it's sitting there in the low 60s. Again, 78% revenues Q over Q, 76 the prior quarter, 58 before that, and now earnings are positive. So earnings have been positive over the past couple of years, but quarter over quarter they're staying positive, with maybe an exception of 1 or 2 quarters here or there. I think the company's fine. I think they're going to capitalize on what they're doing in their space. You look at institutional sponsorship, it's up from about 700 funds maybe just 3-4 quarters ago to over 1,400 funds now. The support is there. It's sitting above that 200-day moving average. I think this base is healthy. And I think in the long run, it's going to be one of the better stocks to own over the next, say, 3 to 5 plus years.
Chris, let me ask you a question about Teladoc, because I know it's a FinTwit favorite, and a lot of people are really bullish on it. And I completely understand all the tailwinds and everything like that. I think you hit it on the nail on the head when you said that the integration right now is the thing to watch. And my I understand the bull case for Teladoc very well, and I've just been scratching my head like, if this company is so awesome, why is it just acquiring growth left and right? Why isn't it like growing like gangbusters organically? That's always been a little bit of a hang up for me.
Mm-hmm.
And the acquisition with Livongo took me a little bit off guard, and that's a thesis changing acquisition. I mean, that's like at the time it was like an $18 billion company acquiring a 15 billion something around there. But I think you said it right. The integration is going to be the thing to watch, because integrations are really hard. And if you look historically, most acquisitions fail to realize the benefits. When you say you're looking at that, what specifically are you going to look at to be like, yes, this thing's going well, or no, this is not? Because everything that management say is going to come through management's filter.
Agreed. And let's start there with management. The first thing that really concerns me is a lot of the management from Livongo have now jumped ship and gone elsewhere, and they're no longer with this integrated company, this merged company. So that's a little bit of a red flag there, and maybe it's a big red flag. And it's obviously the folks that were Livongo. Those were the ones that built that company into the amazing investment I thought it was when I owned it at the time. And I was upset when they actually merged, and I sold my shares and said, you know what, I'm not really interested in Tdoc. And then I revisited it and said, I like the space. I like the fact that they're together. Definitely share the same concerns as you, Brian, as far as can they make this work? Oftentimes it doesn't happen. The one key thing I'm looking for is, can they start to split the numbers out? And they didn't do that this quarter, and they haven't done that in the last couple of quarters since they merged. Of how are the Livongo services performing as compared to the traditional or the original Teladoc services? Because I think the growth for this company is in the Livongo services, not the Teladoc services. So if they can't integrate this properly, they can't even get into their app, and they mentioned that in the call, they don't even have the app fully updated, and that won't come out until probably early next year. And they said it takes time, and I get that when you have such large companies like this, especially when it comes to HIPAA-sensitive healthcare information. But the key thing I'm looking at is if the next 1 quarter to 2 quarters, they really can't get the Livongo services really growing big time and start to becoming the lead services in the company, it's probably at that point where maybe I jump ship. Now, if price really starts to crash here, from a growth standpoint, I'll jump ship as well. But it's concerning right now. I have a lot of conviction in this space, a lot of conviction in the joint company, but there's red flags popping up for sure.
Mm-hmm. Yeah, I think telehealth is that's like a no-brainer mega trend. right? It's like it just makes so much sense for everybody. Getting healthcare at your home, quick visits, right? I don't know if everybody here has ever done telehealth, but if you have like a bug bite or a rash or anything like that, it's just so simple.
Yeah,
So in theory, Teladoc is the top dog, first mover, and all that kind of stuff, and it's done very well if you look back since IPO. But the thing that it just always bothered me is why is it just so acquisitive?
agreed. I'm with you there. I totally agree. And it's something I'm definitely watching closely.
Yeah, absolutely. Why you're touching on some red
Mhm.
flags from Teladoc? Do you consider this news that came out today about Pepsi dropping Teladoc as the client? Do you see it as a red flag or no?
Um, so you're saying Pepsi? I didn't see that news today. Off the top of my head, no. I mean, I'm looking more at the healthcare companies. I mean, if Blue Cross Blue Shield was in an agreement with them and they dropped them, I think that's huge. A lot larger than maybe just one individual corporate entity. Anyone dropping anything is obviously not good for revenues. But certainly if that becomes a trend, and I look at that with anything with stocks is a one-off thing. It's not necessarily a trend. It happens two times, three times. Well, then you have a trend at that point. It's a major red flag if people are starting to jump ship and go elsewhere.
Yeah, absolutely. Thank you so much, guys. As much as I would
Mhm.
love to keep talking about Pinterest and Teladoc, we have a lot of questions to cover. So, Wolf, do you have a question?
Yeah, real quick, just want to say thank you to the 440 plus people who have joined us. This is a massive space by any standards, and thank you to our speakers for being so amazing here. To those in the audience, you may have questions. We're going to try to get through some audience questions in the latter half of this, so feel free to go ahead and I can't say we'll get to all of them, but feel free to DM me some questions. I'll try to pick the most interesting ones. We have some preset questions, but for the last maybe 15, 20 minutes, we'll ask some of the questions that y'all send, so I'll keep an eye on those. Back to you, Max.
Yeah, so the question I have for Brian from Eric. I know for you, certain fundamentals are super important, but what are your thoughts on investing in deep technology companies that are fundamentally changing our world, like Evolve, Rocket Lab, Quantum SI?
So I don't know any of the three that were named. I assume the real question there is there's no fundamentals to back up a story. Essentially, what you have is a story. How do you evaluate it? Is that a fair interpretation?
Correct.
Yeah. So that's a good question. I was researching a company today that is called Vicarious Surgical. They're coming public via SPAC, and they have a beautiful investor deck. And the next Intuitive Surgical, it's a robotic surgical system, and really cool stuff. And it fixes some of the things that Intuitive does not address well. And if you're just going through that, you're like, wow, all this just sounds awesome. And then you get to the part where they're like, oh, by the way, we're not going to have FDA approval until 2023, 2024. And that's fine. That's fine. You just got to know. You just have to, if you find a company like that it's essentially telling a good story, but it does not yet have the numbers to back that up, and you are still interested in it. For example, if it checks some boxes on you, maybe it has a leadership team there that has had success at another company. Maybe they really have some killer business model or technology that promises to like disrupt an industry. Whatever like the thing is that makes it compelling enough for you to go, wow, this is interesting. I am fine with taking small positions in companies like that. However, this is something we say all the time: is no matter how great a story is, still make the company prove it. Like anybody can come up with slides that are just fantastic, but making like having an idea for a business and actually executing on a business are two completely different skill sets. And a lot of times when companies are coming public, especially via SPAC we've seen recently, they just make promises about, okay, the next 5 years, we're going to report 70% compound revenue growth. And based on our 2025 estimates, boy, are we cheap today. And it's like, okay, let's say I buy that. I think let's say there's reason to buy that. Fine. I would take a very small position. For me, that would be 0.5%, so 0.5% of my portfolio. And then I would watch the company and I would make them prove to me that the thing that they are doing, they're actually executing on. And it's okay if it's okay to pay an extremely high valuation multiple on that, so long as the market cap is tiny when compared to the opportunity. For example, what I mean by that, the company Vicarious Surgical, which I do not have a position in, their market cap with the SPAC is like 1.5 billion, something like that. And it's like, all right, if this company is the next Intuitive Surgical, this could be a 10, 15, 20, 30 billion dollar company someday. Therefore, if the company executes and I buy today, I could earn literally 10, 20, 30 times my money. If the company doesn't execute, look out below. I could lose 80% of my money. So that would be a company that if I was interested in, I would buy a tiny little bit, and then I would watch the company. And as the story played out, as they received FDA approval, as they shipped their first systems, as they had to get their gross margin into positive territory, I would add on the way up. I would be happy to add at higher and higher prices over time because the company's risk level would go down as they execute. Conversely, if the company doesn't execute, if the stock tanks, if they are having problems with production or delivery or FDA approval or whatever, I don't add anymore. And my risk is capped. One of my favorite investors ever is a guy named Tom Engel. And he has this wonderful saying about growth stocks. He says, if this growth stock is the next great growth stock, a little is all I need. If it's not, a little is all I want.
It's a good one.
That's perfect. I love it.
It's a great quote right there. Love to hear that. A little is all I want. Nice. That's awesome. I might steal that and tweet out, but no, I'll give you credit. Don't worry. So I'll follow that up with a question that, you kind of touched on in the beginning where you were talking about how some of these companies are being based off of extreme valuations in future years. So it's to both of you, and I'll go to Chris first and then Brian. Would love to hear from you as well. How do you balance fundamental and technical analysis? And I got a lot of people sending me questions about this, which is, everybody is out here saying that they're a fundamental long-term investor. So where do the technicals come into play? And can you be someone who values both?
You can do both. And a lot of the foundation of what I do when I invest comes from the canceling system, which was developed by William O'Neill from Investors Business Daily. And what he does is he combines both the fundamental analysis and the technical analysis. And it's limited as far as how far he goes with the fundamentals. And what I've always spoken about, and what I actually do is I build my screens inside MarketSmith based off fundamentals first. So there's a lot of times when you might have these SPACs or these up and coming micro or small cap stocks that don't make my screens because the fundamentals aren't quite there yet as far as what the parameters that I'm putting in there. So what I'm looking for initially, especially when it's a young company and it's new, maybe it IPO'd within the last few months to a few years, earnings per share is still negative at that point. But what you're looking for is you're looking for a reduction of the loss in the earnings, and you're looking forward for that guidance to say, okay, when can they become profitable? And if you look historically of the best performing stocks, you don't really have to be there day one. And to what Brian says, if you position size your positions properly, you're not going to have major risk if it doesn't work out. And if it doesn't work out, you take the loss, you write it off, but you're fine because your risk is relatively small at that point. And you can always pyramid up. And I do believe in pyramid up. A lot of people like to average down, or average in is another term I've heard recently. But I think if you average up, that actually supports the case that the stock is doing what you anticipated it to do, and it's working at that point. And there's no problem averaging up, especially when you're looking at something that's going to probably run for 10 or 15 years. And if you look at all the FANG stocks, they've run for 10, 15, 20 years. These things don't just run for 1 or 2 years if it's a great game-changing type stock. So you have a lot of time to get in. There's no rush where you have to get in right now when it's something that's going to give you opportunities, especially on pullbacks. And every great stock's going to have a pullback over the next several years. So I do look at the fundamental analysis. I specifically look at earnings per share, and I look at the growth rates of your sales, your revenue. And I go after that. And I set up my screens, my parameters to kind of sort stocks that have increase in sales and increase in earnings, usually 25% Q over Q or greater. And then from there, I look at the technical side of the equation. I'll dive into other stuff in the income statement. And what I do for a living is I look at my P&Ls every month as far as what my business is. I'll look at some of those parameters, but I don't go crazy. I mean, you could look at cash flows and you could look at net income, return on equity, of course, valuation we talked about, market cap. How does the market cap line up with other folks that are in that industry, and what's the opportunity to grow from there? And then the last piece I kind of tie into both the fundamental and technical analysis is institutional sponsorship. At the end of the day, as much as retail investors are getting more and more involved in this market with all the options that are out there through our phones, the institutions still drive the stocks at the end of the day. And you want to see the big funds diving in there with billions and billions of dollars, Q over Q. So you might start with a stock that has a few hundred funds that are buying it now, and then you look 1 or 2 years forward, and now you're at 5, 6, 7, maybe 1,000 funds that are in that stock. The price is going to rise as that fund institutional sponsorship grows as well. So those are the couple things that I look at. I definitely try to combine both fundamental and technical analysis. Fundamental really just tells me what to buy for the most part. And then the technical occasionally will tell you maybe when to get in if it's a pullback. I don't go nuts with anything other than maybe just moving averages. I don't get into a lot of different indicators. I know a lot of folks believe in it, get into that stuff, and it certainly works for certain folks, especially traders. For me, it doesn't. I mean, if something's going to violate a major moving average and I need to get out or sell because I think it's breaking down, I'll use the technical analysis. And then on the flip side, I'll use it when I'm trying to get into a stock. If I think it's in a nice support area, maybe it's built some type of a base. You've heard cup with handle type bases, flat bases, support zone, stuff like that. I try to keep it as simple as possible, but I definitely mesh the two together.
Real quick, can you rank your top 3 moving averages in the order that you look at them?
Which ones? I use the 50-day and the 200-day moving average for the most part.
Perfect. Awesome. And I'd love to just throw that question over to you, Brian, and then back to Max.
Sure.
I'm not about the moving averages, Brian.
Yeah.
Just
yeah. So I don't use technical analysis myself. I will say that I have a lot of respect for Investors Business Daily and their relative strength metric, because what in essence that is designed to do is show you what stocks are outperforming the most over the last, I'm pretty sure that's year. Mm-hmm. And that tells you this business is succeeding. That this stock is going up, and there's almost always a strong reason why it's going up. So the relative strength is an indicator to me of business momentum, business fundamental momentum. Revenue is moving higher, margins are moving higher, profits are exceeding or losses are contracting. The business is doing something well, and that's why I think it's a great idea to go shopping for stocks that are on the 52-week high list, not the 52-week low list, because the 52-week high list is businesses that are doing something fantastic. One tip that I think is a good tip for people that don't want to subscribe to IBD but are interested in some of their stock picks, there's a wonderful ticker. There's an ETF out there called the FFTY, which is like the IBD 50. And if you crack that thing open, it'll show you the most recent 50 IBD stocks that are moving. That is a wonderful place to go searching for stock ideas because those are the businesses in there that have really strong relative strength. And again, it's because the relative strength is usually an indicator of business momentum. So every month or so, I peruse through that thing to look for stock ideas. And if I find a small company that is the market is rewarding, that the fundamentals moving in the right direction, you can bet that's going to go on my research list.
Yeah, Brian, you bring up a great point, and that's one of the key technical analysis tools that IBD does offer is the relative strength. And if and I'm not. I don't get paid anything by IBD. I'm not promoting their services. It's something I just use. It works for me. But when you have their services, you have the traditional relative strength rating, and it's charted out on a graph with the stocks. And then they have a 3-month relative strength rating. So it kind of hones in on what's actually gaining some more strength in a more recent quarter versus the overall year as well. So you can kind of start to separate maybe what's a lag in RS, a stock that's been really strong over the past 12 months, but maybe it's starting to fizzle out, versus a stock that maybe wasn't as strong in the last 12 months, but in the last 3, it's really strong. So to give you an example, if you have XYZ stock and it has a relative strength rating of only 60 out of 99, which would be your strongest stocks in the market, but its 3 months relative strength rating is at 95, it's kind of giving you a hint that, hey, this stock is really starting to pick up some steam and it's getting a lot stronger versus its peers in the last 3 months versus the previous 12 months. So you are right. That's one of the greater technical analysis tools that you can use out there. And like I said, I don't go crazy with technical analysis either. I do like to look at charts a lot, but I try to keep it as simple as possible.
Yeah, great point. Keep it simple. I like it. I have a question for Brian from Blaine. I think he's listening in. So thank you so much, Blaine, for submitting this question. Brian, what is your investment kryptonite, and what are you doing to counteract this weakness?
In kryptonite?
Yes.
What is my investment in kryptonite?
No,
I
no,
don't
no.
know.
What is
You
your
mean crypto?
investment kryptonite? Yes.
Oh, what is my weakness with investing?
Yes.
Essentially? Okay. I got you. I thought, is that a stock I don't know? Is that a cryptocurrency I don't know? What is happening right now? Oh boy, I mean, I have plenty of weaknesses. I have plenty of biases. I'm a human just like everybody else on this call. I would say my number one is that whatever I am hugely susceptible to recency bias. So whatever is the last stock I researched that that interests me, I tend to become very mentally focused on that stock, and I can have a habit of like ignoring stocks that like really excited me almost even like a month ago. So one thing that I love to do is buy more of the best stocks that I own, and if you're always on the search for new, shiny, flashy things, it can be distracting when in essence, rather than buy that new thing, the smartest thing to do is just for me to go back and add to Pinterest, add to Etsy, like add to businesses that I know, love, and think can grow for a long period of time. But I mean, that's just one of my many weaknesses. But if I had to point one, yeah, I'm addicted to researching and finding the new shiny object.
Yeah, I think a lot of us can relate to this, and myself included. And I guess there is a reason why they say winners keep winning. So I pretty much do the same thing, just keep adding to the winning stocks in my portfolio.
Yes, sir. I'll throw this one over to Chris since that one went to Brian. Chris, given the inflation scare that we're currently facing and the infrastructure-focused economy, how do you plan on building your portfolio, specifically, I guess, the new stocks that you would be adding to, rather than, we just talked about adding to winners, but when you're continuing to add new names to your portfolio, how are you finding those, vetting those, and then adding them?
I wouldn't necessarily say that inflation or overall what's going on from a macro standpoint really determines what I'm going to do. I kind of keep the same set of tools in my tool bag as far as what I'm searching for, what I'm looking for. So it goes back to what I said earlier, just looking for stocks that have certain fundamental analysis. I'm looking for certain businesses or stocks that have a new or growing product or service, something that's very innovative to the market. And although it may not be in favor right at this particular time, because perhaps we're seeing some type of a cycle going from growth stocks to value stocks or value to growth, or whatever it may be. One of the things I posted a little bit earlier today is that the two industry groups that are really leading with the most new highs today is the transportation sector and then the building sector for both residential and commercial. I mean, those really aren't industries where I'm looking to buy stocks long term. However, if you're a shorter term trader, you want to pay attention to those new high list and the strongest industry groups, because those are the stocks that are actually trending higher at this point in time. So when it comes to inflation, I'm certainly watching it more from a personal standpoint in my main life outside just investing in the stock market, as far as what I'm doing with just income I have coming from elsewhere, any real estate that I own. But even there, it's all cyclical. What comes is going to go, and vice versa. So I'm not going to make many decisions outside of what I normally do, just because inflation may be creeping up or going higher. I've definitely made mention that I've bought some other investments outside of stocks, whether it be crypto or something else, to perhaps maybe hedge against inflation or devaluation of a dollar. But that's all very speculative. It's not guaranteed, and it's not something I really advise anyone else who doesn't really understand it or hasn't done their own due diligence on it. So ultimately, when it comes to stocks, I stick to my plan, and I'm going after the stocks that are kind of just increasing earnings, increasing revenue. They've got a great new product or service, and I think it's going to become, Brian used the term earlier, a mega trend perhaps. So if you look at the genomics play right now, I mean, regardless of what happens with inflation, I think that's a mega trend. Now, do I know which stocks are going to become the mega companies of that trend? No. Now, I own the ETF from Kathy Wood, so I'm trying to grab everything that she's got in there, and then I'm trying to individually pick out certain stocks. But inflation is really not going to determine what I'm going to do as far as what stocks I'm buying going forward. I'm really just looking for those mega trends, and I'm going to buy into them.
Yeah, perfect. I like it. So I have the next question for Brian. What stock have you held through the largest drawdown? And what helped you stay the course when many panic sell at or near bottom?
Peak to trough, I assume this is asking. Netflix, I'm guessing. Netflix in 2011. I think that peak to trough, that was 85% drawdown. And the way that I held was by doing what I always do, watching the business, not the stock. If you looked at when it fell 85% peak to trough, that was in the Quickster debacle when they rolled out, they split the DVD by mail and the video streaming into two different services, and people were gnashing their teeth saying, "You're raising prices 60% and all that kind of stuff." And if you just read social media and the headlines, you would have assumed that subscribers were about to like fall through the floor. Like everyone was going to cancel Netflix and get away. And yet that was an awful quarter for them. And their subscriber, I think that quarter, their subscriber growth was flat, but their revenue was still up 15, 20% over the prior year. And to me, it was just like, the headlines or the like what's happening in the news right now is not follow. Like if it was a disaster at Netflix, why is revenue still growing? Answer me that. Why is revenue still growing? So I just watch that, and by having a diversified portfolio and owning lots of growth stocks, if one stock falls hugely, it sucks. I mean, it's not enjoyable to go through that, and there were no guarantees that it was gonna come back. But I still said, okay, is this a short-term headwind or a long-term headwind? Like they reversed course on Quickster, I think in like 3 weeks. Like they said, we screwed this up, and 3 weeks later, they fixed that issue. And yeah, so watch the business. But I mean, I've held lots of stocks that have fallen 50, 60, 70% and not all of them come back. In fact, plenty of them go down and stay down hard. And it just takes, if you're going to invest well, if you're going to pick stocks, you just have to know that is the price of admission. You are going to get some of your stocks are occasionally going to get smashed, like really, really hit hard. Sometimes the company deserves it. Sometimes it's a bad PR move. Sometimes there's something seriously wrong with the underlying business. That is why I diversify and watch the business, because what the business does and what the stock does are two just different things, and I have no ability to predict when they will converge. But I just know in the long term they always will. If the business succeeds, the stock will succeed. If the business fails, the stock will fail. And I just believe that to my core.
Yeah, perfect. I love it. Thank you so much for this detailed response. Wolf, do you have a question?
Absolutely. And I will say, Brian, I think that so many more people, it feels like, understood that concept prior to 2020. And things got a little bit shaken up, but I do believe that they will come back to earth. So my question that I have, and I'm with you, Brian, I would love to hear from both speakers. It was addressed to Brian first, and I think this is really important. So I asked the other day, actually, what is your first step in due diligence? For most people, you see a stock, what do you do first? And a couple people said they check out the TAM. So my question to you, Brian, is how do you go about nowadays figuring out what is the TAM and the competitors for a company when there's so, I think we were joking on one of Investment Talk Connor's post the other day, now you have to factor in the aliens could come, right? And then you have another 7 billion potential customers. And it's like, where is TAM being calculated nowadays?
So there were two questions there. One was, what do I look at first? And second is, how do I think of TAM? Do I have that right?
Let's let's go with that. There might have been a third question in there, which is how do you find the competitors? But let's go with those two.
Oh, okay. All right. So we'll start with what do I look at first? You pick any stock. You give me any stock to look at. The very first thing I'm going to do, and this might surprise people, given how I don't focus on technical analysis. But the first thing I do is I go to Y charts and I put in the ticker and I see two things. One, how is it done versus the S&P 500 over the last 5 years? Two, how is it done since its IPO? Those are the first two things that I look at. The reason I look at those things first is winners tend to keep on winning and losers tend to keep on losing. This wonderful study that JP Morgan came out with a few years ago, showed that did like a 30-year study period, and they found that 66% of the stocks that are on the market will underperform the index over time. With that, and 34% will outperform, and just a tiny minority, like 7%, literally account for like 80 or 90% of the market gains. So just knowing those odds, if you take any random stock, any random story, and you look at it, the odds are that is going to be a loser. That's what the odds are. The first thing you should say about any stock that comes your way is this is going to be a loser. That's what the numbers clearly say. The way that it proves to me that it's not going to be a loser is that it performs for investors. It has beaten the market over the last 5 years and ideally since the IPO. If a company has underperformed, that is a signal to me that there's something wrong with the business. Value is not accruing to shareholders. Perhaps customers are taking all the value. Perhaps society is taking all the value. Perhaps employees or management or some other stakeholder is capturing all the value. I want, as the investor, some of that value to accrue to me. So the very first thing I look at is, has this company beaten the market? If it has, I am much more interested in researching it. If it has lost badly, I am not. That doesn't mean I won't buy it. That doesn't mean I automatically buy anything that's beaten the market. But as a just quick screening tool, if it's beaten the market, that's a great sign. If it's lost in the market, that's a bad sign. Chris, you want to talk now?
Sure. A very similar approach to you as well. I mean, and going back to CanSlim is I want to see the same thing. I want to see a proven track record, and that's why I don't always get into IPOs. Occasionally I will. There's no hard rule that says I cannot. But are those currently quarterly earnings per share? Are they increasing sharply Q over Q? What is the annual increase in earnings? And you want to look over the last 3 to 5 years. So to Brian's point, it's a stock that's actually shown and proven that it's successful at that point in time. If it has that history of saying, okay, the last 3 to 5 years, 20% year over year or greater, that's a solid stock. New products, new services, new management, any other new information that's come to the market that's going to headline that stock or that industry, whatever it may be, that's going to propel it in the future, that has some guidance that's going to say this is a great opportunity, kind of going into your TAM question. What's the supply? I mean, is it a scarce supply? Is it not a scarce supply? What's the appetite for the market? Relative strength, we talked about that. Is it leading? Is it lagging the market? If it's lagging the market from a relative strength standpoint, you're probably looking at a bottom of the barrel type stock. I mean, every stock's going to pull back, but even the great ones, when they pull back, the relative strength really doesn't dip too far down where you're looking at a stock that's maybe single digits or at a 20. People might think they're undervalued or they're oversold. I think that's probably just the doggy do in the pile. You don't really want to go after those stocks. And then you want to look at institutional sponsorship as well, and how many institutions own it, what types of institutions own it. That's a whole nother category that you can get into, because you're not going to know everything about every institution. When you start to identify which institutions perform really well over time, you want to see if those institutions are buying the stock that you're interested in. Do they own it? How much do they own? Are they continuing to buy it? And you want to see them to continue to buy it Q over Q. They pyramid up as well, or they'll average into the stock. They're not just going to buy it once and then move on. I mean, these are massive, massive funds, and they're going to put billions and billions of dollars into the actual equity. You want to see them buying it over and over, and you want to see all the other great, solid institutions doing the same thing. And then from a maybe technical analysis standpoint, you want to look at the market. What direction is the market in? Is the market acting well? Is the market at new highs? Is the market in a correction? Are we in a bear market? And there's certain indicators I will use where I think are buying opportunities that come around maybe once or twice a decade is what are the percentage of stocks that maybe are trading above or below their 50-day or 200-day moving average? If you get 15% of all stocks across the NASDAQ are trading below their 200-day moving average, you're probably near a bottom of the market. And if you like a basket of stocks, that's probably the time you want to invest. And you don't have to nickel and dime it. Just get in. If you like it, you have conviction, you think it's going to do well, that's the time to get in. You look at the S&P 500 right now, and don't quote me on this number, but I was looking at it last night. I think 95% of all stocks in the S&P 500 right now are trading above their 50-day moving average. That's at a historical high. I mean, that's usually not the time you want to back up the truck and just start loading into stocks. It's when you want to see it on the flip side, when it's depressed and stocks are trading well below their 50-day and 200. And I'm saying across the market, that's not individual stocks. When you're seeing 80 or 90% of all stocks below both those moving averages, you're probably coming to a low point in the market. And whether it's now or 3 or 5 months from now, when you're looking in terms of years, it's probably pretty close. And you're going to do well if you start to pyramid into the stock at that point in time.
Let me double back on the TAM discussion, because I do want to add something there, because I think that's a worthwhile thing to talk about a little bit. My thinking on TAM has evolved over time, and just so we're all on the same page, TAM is TAM. It stands for Total Addressable Market Opportunity. What that essentially means is if this company owned 100% of the market right now, how much revenue would it have in any given year? So if a company says its TAM is $8 billion, that means it's currently chasing an $8 billion annual revenue opportunity. My thinking on TAM has evolved over time. I will always look at TAM, and I do like it when management teams, or better yet, third parties, kind of validate the TAM out there, and they'll say, okay, we're our TAM is 10 billion, 20 billion, 50 billion, whatever the number is, because I do like to compare TAM against how much revenue the company currently has. And ideally, you'd find a company that has captured far less than 1% of its TAM. That means that the company has an incredible amount of runway left ahead of it for growth. And that's really what I want to believe. I want to see, if I find a company and I invest in it, I want it to be a compounding machine, which I mean it can grow its revenue and margins and profits at a double-digit rate for decades. Like 10 years, 20 years, even longer is better. The only way that you're going to do that is if you are going after an absolutely enormous market opportunity. Otherwise, you cap out. So I always look, especially if it's provided for me. The thing to keep in mind about TAM, and one of my favorite investors, as my friend Brian Stoffel, he doesn't ever look at TAM, ever. And his big thing is, how can you know what the TAM is? For example, what was Amazon's TAM in 1997? Everyone with an internet connection that also has secure credit card access that wants to buy a book. All right, what's Amazon's TAM today? GDP of the world, it's grown significantly over time. So the thing that he focuses on is not the size of the opportunity today. It's prove to me that you have optionality. Prove to me that you have the ability to launch new products and new services in new markets over time that expand your opportunity ahead. If you can find companies that can do that, TAM doesn't really matter, because TAM is going to grow substantially. So if you find those companies that have a history of making small bets, investing in innovation, and successfully entering new markets over time, TAM becomes irrelevant, because then the company can create its own future. I mean, look at Tesla. What was Tesla's TAM when it came public? Super premium luxury cars in the United States. A few years later, it entered the Tesla energy market. Could it be getting into the ride-hailing market? Could it be getting into the distributed utility market? That is the power of finding a company that has optionality. The TAM becomes so much bigger over time as the company launches new products.
I would agree with that, Brian. I think if you did an advanced search on Twitter and use the term TAM and anything I've tweeted over the last 11 years, if it comes up once, it's probably a lot. I don't use it a lot. It's a good example when you use Tesla. Apple's another great example. I mean, they made computers when they first came out. I mean, how many different industries do they touch now? How many different industries have they revolutionized? From the phone industry to the music industry to the movie industry to the computer industry, um, uh, and on and on. And what are they going to do going forward? I mean, a $2 trillion company today, can they be a $10 trillion company tomorrow? Perhaps. So you are right. The TAM, it's estimates, it's guesstimates from analysts. It could be helpful. It could be helpful when you're looking at what is the market cap of a company, how large do you think it can get based on what it's doing now, and how can it grow going in the future. But it's not something I really write about. It's not something I talk about, and it's probably like Brian's buddy, something I really don't look at that often.
Yeah, absolutely. Wow, it's been 45 minutes, and I hope you guys taking notes because it's just been amazing. Thank you so much, Brian and Chris, for bringing so much knowledge. I think we're gonna do one more question from all the listeners, and then as an appreciation for all the live audience, we're gonna bring a couple of people to ask questions from the audience. So if you guys are okay with that.
Sure.
Sure. I got a hard stop at 8 though. So hopefully we can squeeze that in.
Okay, then I have one last question from the audience now, and this one's coming from Kale, so Coffee in Crypto Zero, who has had amazing growth. If you haven't checked her out throughout April, she just joined in April and is nearing 4,000 followers. So she asked a really good question. She said, Chris, you kind of briefly mentioned owning Cathie Wood's ETF, one of the ARK ETFs, and she'd like to know what your take is on all the people who criticize ARK, and if you personally believe that the ARK ETFs are a good investment.
So I only bought my first ARK ETF this year, and it was the genomics one. And it was partly because I was just starting to do some decent due diligence into the industry. And I kind of looked at it and said, oh, wow, there's dozens of companies I can look at and I can own and buy. Many of them have revenue. Many of them don't have revenue. A lot of them are treated more like, say, a pharmaceutical company where it's this expectation of maybe what the future could be. And I was overwhelmed when I first looked at it, and I said, why don't I just buy the ETF at this point? And the ETF has done really well over the last couple of years, but you know what? I think the industry can definitely go 10x from here as an industry as a whole. So if that's the case, I believe that ETF, as long as they manage it well, could probably do something similar as well. So I decided to buy into it. I put an annual post up each year saying, explain what I think the trends may be. And one of the things I say at all times, I do honestly believe this, that probably 95% at minimum, 95% of all investors probably should just invest in index funds and kind of just move on from there. So whether it be index funds, if it's a low cost ETF, if you believe in a certain sector, whether it be technology or space or genomics, buy the ETFs. And Brian brought up some great stats before as far as how many stocks are just going to underperform the market. It is extremely difficult to outperform the market. And if you're not going to put the time and effort into it, it's probably best to just put your money in funds. Both my kids have their money for when they get older in index funds. We have money, my wife and I, in the index funds because we know we're not going to outperform stuff. I have a longer term account that's larger than my growth account. We don't really touch it. We try to buy some of these innovative companies, but it's usually companies that have been around for at least 10 years. And it's usually not a new company that just came up in the last 1 to 3 years. So I think for a lot of investors, the ETFs, the index funds are probably the best way to go. And if you want to allocate a small amount of your capital or your overall net worth into growth stocks, I do it because I enjoy doing it. I love investing in these stocks. I love researching these stocks. I love trying to, I don't know, maybe this is a bad term. I have a lack of a better term. I like to beat the market myself. That's why I have a growth portfolio. For me, it's fun. It's something I truly enjoy. I have a passion for it, and that's why I do it. If I didn't have a passion for it, I wouldn't look at it. And my wife is my other half, and we share everything we do. She could care less about the stock market. She would never do it. It's like just put it in the 401k, put it in the index fund. I'm done. Call it a day. I love doing it, but I think the majority of folks out there, and FinTwit is probably a very small piece of the majority of folks. We like to do it. Everyone else probably just go with index funds.
Let me just say a couple quick words about Cathie Wood. I think she's fabulous. I think she's very smart. I think what she's built at ARK is awesome. I really dig her investing style. I love that she is willing to go out in public and make bullish calls on conviction that she has. And I think her funds are going to do great over time. She's making concentrated bets on innovation, and I think that that's a fabulous strategy. The thing about Cathie Wood is she's become essentially so popular and so many people just follow her blindly. I think she has the potential to be our generation's Peter Lynch. What I mean by that is there were lots of people that knew Peter Lynch, they saw his track record, and they invested with him based on his name. And then when he had a bad quarter, 2 quarters, 3 quarters year, because his style was out of investing, they bailed on his funds. And they actually lost money on a fund that returned 29% annually at the time that he was at the helm. Cathie's portfolio and the ARK portfolio is going to ride the growth train. If growth is in fashion, it's going to do great. If growth is out of fashion, it's going to do terrible. I worry that people are going to look at that. They're going to buy into the funds. It's going to have a bad quarter. Growth is going to go out of fashion like it has over the last, 2 months here. And they're going to lose money on Cathie's funds, even though her funds, I think, are going to do fabulous over long periods of time.
Yeah, and I think that's the problem with just social media these days, and we can specifically talk about FinTwit. That's what we're on right now, Brian. There's a lot of noise out there, and it is this instant generation that we all seem to be living in, regardless of what generation we come from. It's just everything's instant gratification, instant now. Let's have success, and I think it's a little harmful what happened in 2020. How much everyone's portfolios went up, how well and how all the growth stocks did. I think some people have this false expectation of what we are supposed to be doing year over year. And when I hear, oh, I only made 10% last month, or, oh, I'm only up 20% for the quarter, I mean, that's ridiculous. Those are the types of returns people would beg for the whole year prior to what we have in the last several years here. And we've been in a solid bull market for the last 10, 11 years. We are going to go through a bear market. And I get this a lot on my Twitter stream is, oh, we're not going to have those bear markets you saw in the past. I'm sorry to tell you, we are going to have those bear markets again, and they're going to happen. I don't know when they're going to happen, but in 2000 to 2003, we sat through a near 3-year bear market. 2007 to 2009, when the market bottomed, that was a 1.5-year bear market. We're going to go through one of those again. And whether that happens this year or happens 5 years from now, I don't know, but it is going to happen again. And you are right, Brian. You can't time the market. And what she's doing is great. And right now she's out of favor with FinTwit and social media, but I'm sure Peter Lynch would have went through the same scrutiny if he was on social media back in his day.
How have her funds done since inception?
Phenomenal.
I rest my case.
Yep.
I rest my case.
Phenomenal.
Yeah, but that's why I would say about half the things I tweet are about dealing with declines, because that is the only that's like where 90% of your mental focus should be. How do I keep myself from doing something dumb in a decline? Not selling when everything's working is easy. Not selling when nothing is working is really damn hard. It is super hard to go in real time through a downturn and watch second by second, minute by minute, your portfolio underperforming airlines, right? Mm-hmm. It's just painful to go through. And when you look backwards and you see, oh, sure, the tech bust, that sounds terrible. That was 2 years of nothing but pain for growth investors. Years of underperformance. Years. Think about the mental fortitude that you need to endure that. That is the price of investing in growth stocks. That is the price. That's why I constantly remind myself that is the price. I'm in this for the long run. What happened in the last day, week, month, even year doesn't matter.
Totally. Unfortunately, I was just coming out of college when that was happening in 2000, and I didn't have a lot of money in the market. I started trading in 98, and I lost a lot from a percentage standpoint. From a dollar standpoint, it wasn't so much looking back. But be all right. If folks are getting nervous over what's happened over the last 6 to 8 weeks, imagine extrapolating that out over the next 24 months, and it just happening week after week after week, and it was brutal. I'm glad I was just very young when that happened, but ultimately, I think, Brian, you and I probably both agree, it's going to happen again. Whether it's 2 years or just a year, we're going to go through other substantial bear markets, and everyone just needs to be prepared for that.
'Tis why you need to know what you own and why you own it. And 'tis why you need to focus on the earnings reports, not the stock price, because the market will test you, period. You want to earn good returns, you got to pay the price.
You put a quote up recently, and you said emotional IQ is a lot more important than your just intelligence IQ. And when it comes to the market, that is 100% accurate.
People
Yeah.
read what I write?
Every now and then, I think. Well, anyway, thank you so much, guys. And we're going to open for the remaining time for the live audience. And I think Mark has a question.
I'll just ask really quickly. Thanks, guys. You guys did a good job. You guys were talking about obviously stocks going down and it testing you. You know, what we've seen recently, obviously the SPAC bubble completely unwound. Some of those names are down 90%, 70%, whatever it may be. Some of the hot winners of last year's with good fundamentals are down 30 to 50% right now. I mean, when was the last time either of you, I've been investing for about 6-7 years now. When was the last time either of you have seen a market where all the indices are at all-time highs, but some of the big, great companies supposedly in the future are down 30, 40, 50%? I feel like I haven't seen a disparity like that in my time, so I'm just curious if you could touch on that.
2013. It's the last time I saw it. You have to remember that the stock market is a fashion show. What is hot and what is not at any given time is all about fashion. Where is the momentum in the market right now? Right now, it's in airlines and oil companies and value stocks. I want to own 0 of them, 0 for the long term, 0. So I just personally fully expect that the stocks that I own will occasionally be in fashion, will occasionally be out of fashion. But if I'm right about the business, that I will eventually be right about the stock. But I vividly remember in 2012, 2013, somewhere around there, all of the great growth stocks that were on the market were in quote unquote a bear market, even though the S&P 500 was at a high. So this isn't unprecedented, and you should expect it to happen occasionally.
It does. And rotation, a lot of folks hear that term quite often, especially on social media. There's rotation of stocks and it's going to happen. It's cyclical. You look at a chart going back over 100 years in the market, this happens over and over. And a lot of it comes back to just the pure human nature of the market. The market is made up of us, humans, and it's the way we react to stuff and how we kind of jump to what's in fashion, to what's not in fashion. And Wall Street plays on that. I mean, Wall Street's got maybe a little bit smarter with their algorithms and how they program trade. And they kind of prey on what we're going to do based on historical patterns. So you are right. It's going to come in out of fashion from time to time. You just have to be prepared for it. And I think, Mark, when you look at stocks, and I have it like Tdoc, we talked about it earlier when we opened up this call. I mean, it's down almost 50%. Now, fortunately, I didn't buy it up at those levels. Now, if I had bought it at those levels near 300, it was down 50%. I mean, I'd be in a real quandary at this point. But it's going to happen, especially when stocks get a little bit ahead of themselves, and they certainly got ahead of themselves last year. Basing is healthy. You want to see stocks base. A stock must base at certain periods in its journey in order to make that next 2x, 3x, 5x run. So it's very healthy for a stock to base. If the story's intact, if the financials are and all the fundamentals are intact, that stock is going to do really well. And I always go back to Square. Square is one of the stocks where I bought it in the middle of that long 18-month sideways pattern in 2019 when it had just went 10x. And I'm like, all right, this is a great stock for the future. It's going to happen. And then little do you know, COVID happens. It drops from 70 down to 30. And then before you know it, it's up near 300. So the great stocks will come back. They will work out. It's extremely difficult to hold. And if every once in a while you have one that doesn't come back, that's where position sizing comes into play. You don't want to over leverage your portfolio into 1 or 2 positions, or at least I don't. I can't tell everyone what to do, but I don't over leverage my portfolio into just a few positions so I can crash my portfolio. I position size my positions properly. So 1 position or 2 positions are not going to take me out. Now, when you have a full growth portfolio, you might ask, well, what if they all go down? Certainly that can happen. But there's going to be some disparity between the different stocks. And right now portfolios are down, and mine's down probably about 23% from its high back in February. But overall for the year, it's only down a couple percent. So it's not terrible. And it is something I'm watching right now because growth is still not performing well, but they will come back into fashion.
Yeah, absolutely. Great point. I know Brian has to go, but we were just talking about Kathy and ARK Invest just popped in, and they have a question to ask. So if you guys can answer, that would be perfect.
Yeah, I can do one more.
Perfect.
Hey, sorry. Well, first of all, I just want to make sure that everyone knows that I'm not associated with ARK Invest. I'm just a fan. I track their their trades and everything each day. I've learned a lot from this space. It's really been awesome hearing you guys talk, so I appreciate it. I just kind of wanted to know if you guys had a favorite ARK Invest ETF, if there's one that, you know, maybe if it's not one, if there's a group of them, or one that you don't like, or anything along the lines of that.
The ARK Invest ETFs, all of them are great places to go for ideas. Again, I'm a big fan of taking ETFs and picking through them for stocks that might interest you. They're a starting point of my research, not an end point of my research. And several of the ARK funds, the ETFs, have just done fabulously well. I forget what they have one that's the SaaS and fintech and that kind of thing, and it's just been a wonderful place to park cash. If I had to pick one that I was like, yes, it would probably be the genomic one, not because I'm like, wow, this style or anything like that is just fabulous. It's that genomics is just really confusing, really hard. Biotech is an incredibly difficult business model to make work. It's bleed, jackpot. Like, that's how it goes. So the odds of failure are incredibly high. So I think that genomics is going to be a big market moving forward, and CRISPR is going to be a big market, or at least they have the potential to be. I know I have no ability to pick the winner in that market, so that would be one that I would say playing it with an ETF might make sense.
I agree, and as I mentioned a little bit earlier, to one of the questions that was from Kale, I own the ARK-G Genomic Revolution ETF. I think their innovation ETF has been phenomenal. The fintech one you mentioned has been great. I think they're all solid, and it's the same thing. When the ARK-G ETF came out, I instantly went to the list. I wanted to go through it, and like Brian, I was overwhelmed by genomics. It's just not my specialty. I mean, I'm an architect by degree. I mean, I work in construction and design and project management. I can't comprehend everything that's there. I bought my first genomic play recently, and I have a few, 3 or 4 that I'm looking at to potentially buy. But again, I just feel safer owning the overall ETF at this point. But I think all her ETFs are really solid at this point, and certainly great idea generators. If you want to really get to know a space and you wanted to pluck 1 or 2 out, just go there and see, okay, she owns it. Who else owns it? What other big funds own it? And what's the opportunity there?
Yeah, absolutely. Brian, how are you on time? Do you have to go?
Yeah, I got to run. But
Yeah.
Thank you, Max and Wolf, for putting this on. This is fabulous. Chris, awesome to chat with you.
Yeah, this was great.
I assume the conversation is going to keep going, but I got to go tuck my kids in.
Yeah, absolutely. Thank you so much for coming, Brian. I really appreciate it. We have so many more questions left, so maybe we can do a follow-up at some point.
Sounds good.
Thank you, Brian. I really appreciate it. Guys, I can stick around for a little bit longer if you'd like.
Thanks, Brian.
Yeah, I think I
perfect.
have about 10 minutes, so we can take a couple extra questions from the audience if Chris is okay with it.
Sure. We can do about 10 more minutes.
Yeah, yeah. Let's take a question from the audience, but real quick, just want to let everyone know that this was a fantastic space for everything that's been going on. Shout out to Max. This was the most people that we've ever had on a space. We had above 500 people listening here. So if anybody is feeling nice and friendly, you should go give Max a follow. But yeah, back to you, Max. We should bring up the next speaker.
But honestly, dude, my thought is with everything that's going on right now, I've been watching crypto go crazy the last couple of days. And, you know, obviously nothing goes up forever. The rug's going to get pulled at some point. I'm still a crypto believer for the long term. But I want to know if anyone else or in the panel had any thoughts about what's been going on recently, you know, any maybe ideas on to play it, or just take overall thoughts on crypto.
Did you take profit, Chris, on Ethereum?
I didn't take any profits, no. I own Bitcoin for a couple of years now. I've been holding it. I think what everyone has to understand is it's everyone has a different idea of what the definition of crypto may be, and specifically what particular crypto. I mean, I look at Bitcoin, I look at Ethereum, and they're just different. They have different use cases as far as what they're out there for at this point in time. Bitcoin, I personally believe, doesn't mean it is, that it's a store of value. Does it have some type of function or use as a currency? I think it does. I just think the amount of transactions it can process per second is very low comparative to just what we have with Visa and MasterCard these days. So I hold Bitcoin as a store of value. I think coupled with that, you have to understand that Bitcoin works within a halving cycle. And when you look at the cycles, you have these large drawdowns that happen every 4 years or so. And the last one was about 80%. The one prior to that was probably another 80, 85, 90% or whatever it may be. I do believe we're going to see another large drawdown. I don't know what the percent's going to be, but I think anyone that owns Bitcoin in particular at this point needs to be prepared, as Brian and I were saying earlier with growth stocks, for a large drawdown of 50% or greater going forward in the future. So depending on where you buy it, why you own it, for how long you plan to own it, just understand that it may go through that large drawdown again. And it won't be the only one. I think there's going to be multiple ones going forward. So I look at Bitcoin as a finite supply, as a store of value that folks are buying, very similar to a piece of art, where it's just supply and demand at this point. And there's always a lot of debates, a lot of even arguments as far as what it is. And it's become a religion, which is a little silly. I own it as an investment, as a store of value. So if I buy it at A and it goes to B and I make money, it's a successful investment. I understand that. I don't think it's going to become a currency. I don't think it's going to displace the US dollar. It's not going to displace the euro. I don't believe it will. Maybe it does. That's just not my belief. I look at Ethereum, which I started buying in March, and I started putting a little bit more substantial money into it with a couple buys in March. And I'd like to buy it one more time, but it's really just, it's gone up like 50, 60% in the last month. It has more use cases. I mean, you look at smart contracts, you look at different proofs of stake, you look at NFTs, you look at other applications that can be built on top of each other. And I know Naval and a few others have kind of termed that as Legos, just building blocks on top of each other. Ether is the currency, which is the first application of Ethereum. I just think Ethereum, because of the use cases that it has, and I know there's costs with processing it and with the gas and the fuel and all that. I do believe it has some potential here as well. So I've started to buy Ethereum recently as well. I don't get too much into the altcoins. I think somebody else would have to speak to that, but I'm buying these just based on what I think could be the future of blockchain. And I think these particular cryptocurrencies could be a part of what blockchain, which is the larger technology, which I think is the future of a lot of things with the internet and fintech and smart contracts, is something I just want to be invested in at this point in time.
Yeah, that was a great answer. I think Wolf got kicked out of Spaces again for some reason. I don't know what's going on, but it's kind of tough. Let me see if we can get another person really quick. I just approved David as a speaker. David, can you hear us?
Guess we're having trouble with that.
Yeah, no, I still don't see him as a speaker yet, sadly.
That's been rough. So every time when I bring people as speakers, for some reason they disappear. Maybe I'm hitting the wrong
Maybe
button.
if you
I
have
don't
them
know.
request to be a speaker and then you give it to them, it might work.
And this is exactly, I have at least like 10 people right now who requested to speak. So I just go there, click approve. If for some reason they disappear after I click approve, maybe there's something going on with Spaces in this function. I don't know. I'm not sure what's going on. Let me bring Eric as a speaker. I know he's been around for quite some time, so he's been patiently waiting.
Can you guys hear me?
Oh, here we go.
We can hear you,
Yes,
Eric.
we can hear
Okay,
you.
perfect. All right, I've
Perfect.
been waiting. So my name is Eric. I follow Brian Feroldi. Obviously, he's off now, but I'm a Motley Fool member, and I've been investing in stocks since 2017, and also crypto. And yeah, mainly me too. I have Bitcoin, Ethereum, 80% Ethereum, 20% Bitcoin, and I have some Chainlink as well. Actually, so it's probably like 80% Ethereum, like 15% Bitcoin, like 5% Link. Those are the three cryptocurrencies I believe in the most for the long run. And stocks, growth investor, some value, like Facebook. I think it's a combination of value and growth. It trades at a pretty low P ratio compared to other growth names. So, anyways, but my question was mainly for Brian because I follow him really closely. But Chris, I'll take advantage of you and of Max as well and Mark. And so basically, the question for me is like PayPal is like and like Square and SoFi and all these, like there's a bunch of fintech stocks or companies, whatever you want to call them. And now we have Coinbase that just recently went public. And basically my question is, it's a very competitive space, and can they all succeed going forward like in the long run, and especially now with like Bitcoin and Ethereum being like alternative currencies or like wanting to be like alternative currencies. I even fear that they may like what's the word I'm looking for? Like disrupt even like innovative companies like PayPal and Square that we think right now are like disrupting the banks, so like Wells Fargo and Bank of America. So like now I'm even like worried about like the cryptocurrencies that are coming out, like disrupting PayPal and Square, which I thought were like great investments for the last 2 years or whatever. So yeah, it's my just kind of my question, TAM, and then just like can they all succeed or not, basically.
I mean, I guess I'll start with that. I love the fintech suite of stocks that are out there. I've owned a number. I've owned PayPal in the past. I currently own Square. I own Visa. I used to own Mastercard in the past. Mistake that I ever sold Mastercard. Um, I had SoFi recently through IPOE. I sold it and then rolled that into call options. I do think the space can certainly, it has enough room for all of them to succeed. I think all of them, they're not necessarily always competing directly with each other, although some of their services may. I think they're all trying to go into different segments of the market. And I think when you look at even just the United States, there's different segments within the market of the United States that each of those companies can actually kind of just service. And I think whether you be Square, you be PayPal, whether you're SoFi, there's just different things. And whether it's credit cards, whether it's transactions with crypto. And part of your question was, can they actually get disrupted by crypto? Perhaps they can. I think what they're trying to do, and I think what PayPal, Visa, and Square are doing is they're getting very smart. They're integrating some of the things they do with crypto. Understand that cryptocurrencies, they're probably here to stay for the long run. Whether the cryptocurrencies we have today are here for the long run, who knows? But I think just that industry is probably here for the long run. So I think these companies are being really smart to kind of get ahead of the ball, ahead of the game, more so than the traditional banks. So if you look at your Wells Fargo's and your Goldman Sachs, they might trade those things, but they're actually not getting involved with the technologies itself. So ultimately, to answer your question, Eric, I think there's enough room for all of them to succeed, all of them to do well. And I think when you look at Visa, MasterCard, PayPal, Square, which now look are the core holdings at this point, they've all done tremendously well in the last 5 to 10 years. So I think they're all going to do very well going forward. I think your more established companies are going to slow down their growth at this point, but then maybe some of your upstarts like SoFi could do really well going forward because they have a much larger market to kind of tap into with the new services that they're bringing to the market at this point in time.
Yeah, sounds good. That was great coverage. Thanks, Chris. I think I just made Peter as the speaker. Peter, do you have a question?
Yeah, can you guys hear me?
Yes, we can.
Yes, we can.
Great. Yeah, Chris, I had a question for you. So I know you mentioned the Bitcoin and the high transaction fees and slow transactions on the Bitcoin base layer.
Mm-hmm.
However, I'm curious if you've studied the Lightning Network, which is essentially a layer built on top of the Bitcoin blockchain base layer. It's a payment protocol, and it essentially eliminates the high transaction costs and also speeds up transactions to make them almost instantly.
It
So I'm
does.
curious.
Yeah, definitely, Peter.
So-
Definitely familiar with it. I've read about it. I've read articles. I've definitely heard discussions on different podcasts with some really qualified folks that understand crypto a lot more than I do. I think the biggest concern right now with the Lightning Network is just stability. I mean, they've been talking about the Lightning Network to kind of speed up these transactions for about 5 years at this point. And it's really just the stability of that layer on top of Bitcoin that could really expedite the transaction. So I think if somebody can figure that out, and a lot of times we hear Ethereum 2.0, it almost would be almost like a Bitcoin 2.0. I don't know. Hopefully I'm not saying that out of step there, but if somebody can figure it out and they can get the stability there and it works within the original Bitcoin protocol, I think it's a home run. So far, it just hasn't worked from a stability standpoint, and that's why it hasn't taken hold yet.
Yeah, I'm familiar with one company. It's called Strike. I'm not sure if you've heard of it, but I know they've had some success working with it. They're the founder, Jack Mallers. He's actually working in El Salvador right now on this project called Bitcoin Beach. So they're trying to create like a Bitcoin ecosystem out there using the Lightning Network.
Mm-hmm.
And they've had a good amount of success so far, but I definitely want to study it more.
Yeah, there's potential there. But like I said, I know they've been looking at it for 5 years. I think where there's some disappointment in the industry is it's taken this long to not get it to work at this point. And that's where some people kind of or have been disappointed, throw up some red flags and say, hey, maybe we'll never get it to work when it comes to Bitcoin. And maybe that's why some other cryptocurrency might have to supplant it in the future as far as being a true currency or having transactions as an add-on to an actual national currency or a corporate currency or whatever that may be.
Got it. Thank you.
Yeah, perfect. Sorry, guys. I know it's been over 20 minutes and I gotta go. So that was amazing. Thank you so much for Brian and Chris for taking your time to participate. Me and Wolf, I think, still have a lot of questions left. So maybe, like I mentioned before, we can do something of this nature in the future just to follow up and bring more people, more questions. I think it's great. What do you think, Chris?
I thought it was fantastic. And I definitely, guys, I want to thank both you, Max, and you, Wolf, for putting this on, putting this together, reaching out to Brian, reaching out to me and getting this going. And then certainly all the listeners. I mean, I think it's just fantastic how many listeners are on here, how many questions we get, and just the interest and the excitement around this. I mean, I love this. I could do this all day long. So I appreciate everybody that's been on the call. And certainly, Max, I'm up for doing another one in the future.
Yeah, perfect. I'm definitely on board.
Yeah. Max, you mind if I say one last thing?
Yeah, absolutely.
Yeah, so to all the people here, if you are enjoying Twitter Spaces, me and Max are going to be working off of a joint Twitter Space calendar. So Twitter announced today that they are going to be having calendars for Spaces, but don't expect those to be out and working for probably a significant amount of time based on how Spaces work right now. However, me and Max are collaborating. If you go to my pinned tweet, we have a public Google Calendar. You can click on it. It'll add the calendar to your calendar. We do not see your email. We do not see any information. We don't even know who's on it. So it's completely safe and free. And that way you'll catch all of our spaces, whether we do, hopefully another one with Brian. We're talking with Pulte about doing a space with him. And numerous other, obviously, financial fitness. In addition, you'll see all the spaces that I have lined up for this week. Hopefully, Max will join some of them, including a big one tomorrow night covering financial literacy with 8 different speakers tomorrow night at 8 p.m. EST, and a number of others throughout the week. So that's my spiel, and I hope that you'll join us because I love doing these.
Awesome.
Yeah, absolutely. We have a lot of store for you guys, and the next chapter for Financial Fitness event will take place on March 16th. We have 10 speakers who will be covering gaming industry. So I look forward to seeing you guys there. Thank you.
Thank you, guys. Thank you, everybody.
Yeah, I appreciate you guys. Honestly, best spaces I've been in yet. So I enjoyed it. Thank you guys. Thank you, Chris, Brian, Wolf, Max.
Thank you.
Yeah.
Appreciate that.
Right. See you later, guys. Thank you.
Take
Bye.
care.